What's up, new traders? We're back with another one, and my name is Mr. Bush Trades, of course. Trades by Bush on Instagram, Mr. Bush Trades, both pages is mine, right? And today we are talking about risk management and the key to not blowing your account, right? Most new traders always blow their account due to the fact of bad risk management. And today we're going to teach you why not to blow your account by proper risk management. Most new traders only focus on entries, and it's not your entries or your profits that keep you in the game. It's definitely your losses, and how you handle your losses is what will keep you in the game. So a wise man once told me, think of trading like boxing, right? Defense first, offense second, right? So you want to be able to protect your capital. You can have the best strategy in the world, but if you don't defend yourself and protect your capital, one trade could take you out the game, and then you're cooked. And this applied to new traders, right? Because if you're a seasoned in the game, of course, you're gonna know the rules and the regulations. But who knows? You may be a new trader, you may be a little seasoned, but you could probably still take away from this. So rule number one, right? Risking 1 to 2% per trade, right? So if you have $1,000 account, you wanna risk anywhere from $10 to $20 per trade. That's 1 to 2%. If you have a $10,000 account, you wanna risk anywhere from $100 to $200 per trade, right? And if you have a $100,000 account, whether that may be live or funded, then you could risk $1,000 to $2,000 per trade. So you really don't want to only push for smaller account to try to grow it so big. You want to try to push for more capital, so you're able to get that bigger. You're still able to risk 1 to 2%, which will be $1,000 to $2,000. And if let's say you aim for 1 to 3, right? So you're risking 1,000 to make 3,000. You're risking 2,000 to make 6,000. And then of course, people could live off that on a monthly basis, but always try to push for 1 to 2% per trade. Some may say you have $1,000 account and you're risking $10 to $20. It may sound small, but at the end of the day, it still will keep you in the game. That's why you should push to more capital, not risking more. Rule number 2, always using a stop loss, right? Always use a stop loss. A stop loss is in place, so just in case price does move against you and your analysis is wrong, or maybe just that trade is wrong, it'll take you out the trade. It protects you from unusual market movements, and it protects you from emotional decisions where you may want to hold a losing trade for too long. Just cut your losses short and close out that trade, reanalyze, and look for a next trade. Rule number 3, you want to calculate your lot size based on your account size, opposed to your stop loss, right? And then you want to, fill it out, but that will ensure proper risk management. And by doing that, you can use a lot size calculator. You don't want to guess your lot size, right? Based on emotion or whatever you may think, you just want to guess it. It doesn't work like that. And they are free lot size calculators online. You can find them anywhere. Maybe Baby Pips, maybe My FX book, I think, and they're nobody sponsored, of course. But you can always find the lot size calculator online, right? And you want to ensure to always use it, so your lot size in your trades and your risk management always become consistent. And that's how you ensure proper risk. Some may say, Bush, why are we talking about this? Like, this is so beginner stuff. But it is. Sometimes we just have to talk about things. Sometimes we just have to get back to reality, get back to the holy grail, get back to stage 1, the nitty gritty, and get through it. And talk about the goal of trading. The goal of trading isn't to win every trade. It's to stay in the game long enough to watch your edge play out, right? Who knows? You may come in a game, you may lose 2 trades right in a row. Cool, but you don't have to win 100% to be profitable. You could come in, win 2 trades, right? Win 1 trade, oppose that you're aiming for 1 to 3, maybe 1 to 4, depending on the trade. Sometimes price may play out that way, but that one win can recoup all losses. So yeah, it's not about winning every trade. It's about staying in the game long enough. Maybe your edge didn't play out on that trade. Maybe your edge didn't play out on that trade. But guess what? It may play out in the next 2 trades, and you will recoup all those losses in no time. I say all that to say that good risk management will definitely keep you in the game. So you don't need to have a perfect win ratio, right? It'll just keep you in the game long enough. And as with time, we all get better with things. Ensure we doing the work to get better. So to recap, remember the boxing analogy: defense first, offense second. Risk small. Always use a stop loss and calculate your lot size to ensure proper risk and ensure that you're risking a certain amount every time. And if this helped, drop a like, drop a comment, subscribe in the comments. Let me know your biggest struggle with risk management, how much accounts you blew. If, well, we all blew accounts, so I can't even say if you blew accounts. Or maybe you do, maybe you ain't blow account yet. But how much accounts you blew, who knows? Just talk to me in the comments. And that's it for this video. This was just a quick, like I said, get down to the nitty gritty, starting from the holy grail. And risk management is definitely key to becoming profitable. So thanks you guys for rocking with me. It's a pleasure, of course. Like, comment, subscribe. Like I said, subscribe. More trading tips will be coming. I need to flood YouTube with more content, get myself out there more. And that's it. Thank you.